Emerging markets saw a strong 2025, but can they keep gaining ground? This is Sectors Up Close, and we're talking emerging markets. MSCI's EM index gained 30% in 2025, outpacing the S&P 500 and even the Magnificent Seven, despite the threat of US tariffs looming over several key emerging economies. This Monday morning, stocks in China reached their highest in a decade as AI companies pulled onshore markets up. Jitania Kandari is head of macro on the emerging markets equity team at Morgan Stanley. Jitania, let's start in China. What's driven this run up there?
So China is developing its own AI ecosystem. So globally, there are two AI ecosystems, just like you had the two internets in the US and in China. And I think they are proving that the low-cost inferencing model is the way forward for them, and they have been always cost competitive. And most importantly, China is a digitized economy, much more than other parts of the world. So the ability to use a lot of these AI tools and models in a super app economy is obviously bringing a lot of optimism in what they can do with the proliferation of AI. And also, they also have a lot of electricity, much more than the US, where power constraints are becoming a big issue. China has been able to create a third of US electricity in the last 1 year. So a lot of these positives on the infrastructure side, on the technical side, is driving the market. And of course, with it is a supply chain, both within China and outside China, which services the US ecosystem, and all of that is getting lifted up because of this increasing capex globally by hyperscalers and all the tailwinds that are coming with it.
In 2025, emerging markets investors had to be very focused on uncertainty around trade with the US. Are they able to leave that concern behind, do you think, in this new year?
I think peak trade concerns are behind us. I think US is realizing that it is not possible to manufacture everything onshore. What is really interesting in our work, we show that nearly 50% of US imports are intermediate goods. And why is this statistic important? Because intermediate goods are needed to produce your final goods. And US capital stock has depleted over the last few decades. And therefore, by tariffing intermediate goods, you cannot really bring that production capacity, and you're taxing the domestic producer. And I think that realization will trickle into the markets and into, policies, and in many sectors, that intermediate component will continue to keep that trade story going forward, and there will not be so much disruption. And even with the current news on Venezuela and US's trying to gain control and influence in the Western Hemisphere, I think with the USMCA also, and the talk about Mexican nearshoring 2.0, that should also be a tailwind for the USMCA-driven story for the likes of Mexico. So I'm not very concerned. Yes, some areas of national security may move back, but a whole-scale shift and fears that were expected in the earlier part of the year, I don't think that would really come into fruition.
How do you think that this geopolitical upheaval that we've already seen this year in Venezuela will change the way investors see the rest of Latin America?
Yeah, I think, there are two spheres of influence globally developing. One in the east, one in the west, and I think the Venezuelan situation clearly proved to me that U.S. is trying to get control here in terms of relationships, be it reducing the trade rhetoric intensity with Brazil, providing financial aid to Argentina, Mexico's nearshoring initiatives, which I expect going forward. This is all signaling that there is this whole appeal for this Western Hemisphere by the U.S. Administration. And the underlying thing here is that these countries have natural resources, have rare earths. US has energy. China, on the other hand, does not have energy and imports energy from the likes of Venezuela, but has natural resources. So this natural resource asymmetry is the underlying current in these developments. So I do think that that is uh, going to generally turn favorable for the overall region from a public market perspective. And also some of these countries have high real rates. As we know, they've preemptively tightened monetary policy and now have room to cut rates. So that's another upside trigger. And lastly, the optionality with commodities, because a lot of these countries have commodities and have GDP growth that is tied into the commodity upcycle.
That was Titania Kandery of Morgan Stanley. Don't forget, you can watch more videos on Reuters.com.